Hello and welcome to this week's Market Outlook. This is Jeff Bish, president of MarketGauge.com, filling in for Keith for the week of April 28th. All right, so let's get started with the first section of a big view, the Market Watch, which is the SPYs, Qs, and the IWMs. So the SPYs and the Qs broke out to closed at new all-time highs today. But as Keith has been pointing out, one of the things to keep an eye on is the fact that the IWMs down here in the lower right have not really cleared their 200-day moving average yet. So I think the way you need to look at this is pretty straightforward. The consolidation in IWM around this 200-day moving average is pretty tight. And essentially, until we break out and move above the 159 level, really the 160 is what we'd like to see it clear. IWMs just isn't in gear yet, but I wouldn't let that hold up any bullishness on the SPYs or the Qs for now. That this breakout would be just further bullishness for the overall market. Maybe we see a rotation into the smaller caps and a pause in the larger cap SPY and Qs, but we'll have to wait to see if that happens. Now, in terms of how do we play this divergence, what do we look for? I would just stay in the bullish camp on the SPYs and the Qs, basically until they close below their 10-period moving average, which you can see in this line here. We really haven't had a close below the 10-period moving average in a meaningful way since March, and even then it didn't follow through to the downside. So if you're a member of any of the other services that we have, you'll know that I'm a big fan of waiting for that close below the 10-day and then looking for further confirmation on the downside for that to mean anything bearish. So in terms of just the price action and in even real motion, which we've got under these, real motion is in gear in all of these. We just need IWM to move out. And when we get later in the video, in the premium side, we'll talk about some of the other indexes that could give you a heads up that IWM is about to break out. So if we move on to the volume here, we'll see that the accumulation and distribution patterns here are, for the most part, pretty bullish. You could say that the IWM or the Russell is neutral, but for the most part, they remain bullish. Now, average volume on all of these is light, but that's not a reason to necessarily get bearish at this point. And now, if we look at the relationship between the SPYs and the utilities, here again, this would be a quick heads up if there was something changing, but there really isn't. This remains in bullish territory, and we'll talk about some of the other ratios like this a little bit later in the premium video as well. Now, sector summary is where things start to get interesting. Not necessarily bearish, but certainly interesting. So the thing that really jumps out at me on this particular table right now is that the semis and the home builders both had rough weeks, but really you can see the semis rough week really came in on Friday. That accounts for pretty much the majority of the week's decline. And yeah, it had a rough week in part because Intel, which is 13% of the SMH, was down 9% on Friday. Xilinx, which is 5% of the ETF, was down 17% on Thursday. But all in all, and we'll see this a little bit later when we're looking at the charts of SMH, the trend is still intact, right? And I could say the same thing about the home builders. Yeah, they had a rough week, but again, this has been the strongest 6-month performer, second strongest 6-month performer in terms of groups. And if you look at the individual charts, you'll see that it is still intact. Both of them just closed below the 10-day moving average, but unless they continue lower from there, I wouldn't really worry about it. SMH, in fact, still looks good, even if it does continue lower. XHB, if you're a real motion user on a short-term real motion reading, if it trades below the $40 level, which is around the low of Friday, real motion short term suggests you could see some more weakness there. But at that point, I'd just be looking for the 50-day moving average to be some support. In terms of other negatives, the XLE, you can see turned bearish into a bearish phase. It also really pulled back from the 200, so it rallied up to the 200, and now this move down this week represents a move away from that 200, but it's sitting on the 50-day moving average. So if you take a look at your chart, you'll see it's sitting on the 50-day moving average. If you're a real motion user, you'll also see that the short-term real motion had a divergence at this recent high, and therefore, if it breaks the 50-day, that would be bearish, at least in short term. I'd watch out on the downside if XLE breaks the 50-day. But if it bounces off the 50-day and moves higher, the longer term, even real motion, still is intact. Now, the other big mover for the week, XLV. Keith covered this last week. Had a horrible week the prior week. So this bounce, or this 3.5% big week, yes, but it's really a bounce from a pretty hard hit week prior. The other chart I'd encourage you to check out is the XLF. Right, so the XLF doesn't look like much here. It's up 1.3% for the week, but it has been a good performer for the year and solid in the 6-month time frame. But it just broke out of a 5-6 day consolidation, and it looks pretty good. And now that is led in large part by Berkshire Hathaway, which is a big percentage of that ETF. But nonetheless, it does look good. We'll take a look at KRE later in the video when we're talking about the modern family. So all in all, if we look at the character or the quality of the different sectors, you can see that the sum of the 6-month performance of the sectors is strong. So yeah, we could see a pullback in the market. It would make sense to see a pullback in the market, but so far nothing that I'm saying suggests timing-wise now is the time. If it were to happen, we should have some decent strength from the fact that there's a broad, what this is telling you is that there is a broad sense of strength over a 6-month period measured by industry groups. All right, now, one of the ways we might look for some cracks in the bull market here, of course, would be the market internals. But I tend to focus on if there's something really glaring. And if we take a look at these internals here, the only thing that really sticks out at me is that, one, we're not overbought on the volume. We're not overbought on the advanced declines. And we're not overbought on the McClellan. But the other thing, and Keith pointed this out in last week's video, the McClellan dropping below the 0 line is and can be a bearish condition. So I wouldn't look at this bearish condition and say we have to sell off. Instead, I'd look at this as if we sell off, if we get below that 10-day moving average and start moving lower, McClellan is telling you that we could see some more weakness. All right, but certainly there's nothing here that's really jumping out. And if we were to go to the NASDAQ, it would look exactly the same. If we go to the new high, new lows, this again is showing no reason to be afraid of the market moving higher here. Anything over, when it's over 70, it's basically bullish. If it's over 85, it's really bullish. But waffling up and down up here, I tend to look for things that are more glaring. And in this case, glaring would be that we get these lines turning under the 70 level, and we get price action turning down, and we see a rise in new low count. And that rise for me is about 100. When we start seeing 100 new lows, I would start to say it's a little bit of a warning sign here. But right now, nothing there to be worried about. NASDAQ. Now, I'm going to say NASDAQ looks a little different, but I'm not going to suggest that it's negative at this point. Again, it's under 70, so that's not where we want to be for really bullish conditions. However, again, I would wait for price action to start breaking below the 10. I would wait for new lows to start pushing against that 100 count. If that starts happening, then you can start paying more close attention to that new high, new low ratio. All right, so that's your summary for market outlook. I hope that helps. Keep your eye on these numbers and trade safe.